I'm here today with David Tuckett, who's a professor of psychoanalysis at the University College London. At INET, new economic thinking means new thinking about the economy, not necessarily by economists.
I try to use standard sociological techniques of interviewing in order to try to understand something about the context in which people make decisions, because my argument would be that context very much limits your possibilities. It's a very, very competitive situation, and it's a competition based on the claim that you can be exceptional. Now, of course, we know if we look at the big picture that very few fund managers can be. They are subject to massive amounts of information, and when it goes up, you feel excitement about the possible gains. When it goes down, you feel great anxiety about loss. So you cannot do this job without your emotions being engaged. And so when fund managers say, which they mostly do say, you've got to be careful about falling in love with stocks, they actually know much more in a way than they fully say. In fact, the whole market manages what are the two crucial emotions in the whole situation: excitement about gain and terrible fear of loss. And my opinion is that the way the institutions of the market have developed over time has been created, if you like, by this underlying psychology. Financial markets can never be more than markets in stories about fundamentals. And of course, as George Soros says, that story is self-reinforcing because then the price goes up, etc. And this helps, I think, to explain why financial markets are inevitably much more unstable than the underlying fundamentals. People get terrifically excited, and almost inevitably there's an overrun in the whole situation. The conditions facing them when they make decisions have certain characteristics which limit the kind of decisions, and in particular limit the extent to which you can be rational in the very limited sense that economists use that word.